how much money does it take to get started day trading? Yeah, there's lots of videos about this out there, but I think that we can do a better job. That's my thing. We'll look at stats, do some simulations, and bring you information that you won't find anywhere else. So stick around to the very end and don't let yourself be discouraged by what I'm going to share with you. Yes, there are some hard truths in this video, as there are in most of my videos, but there's some encouraging plot twists at the end. And no, I am going to talk primarily about futures, but you should be able to adapt these concepts to any other asset. The first thing that I want to point out is that you can start learning to trade without risking any capital. There are many people that will tell you that you're not learning anything unless you're dealing with the stress that comes from the risk of loss. That might be true if taking on risk is all there is to your strategy, which is incredibly common in the retail trading world. Many strategies make money not because of their understanding of the markets, but because they take on a lot of risk. That's something that has a tendency to blow up in the long run. So if you want to last in this game, it's best to develop a sound understanding of the market, something that takes quite a bit of time to do. So if you don't have the capital today, don't let that stop you from starting to learn. You might not be able to really take the risks that you want until you're much older, but you can get a head start. And yes, that includes sim trading and just watching the markets on your own. And of course, this channel is the best educational resource there is. I really believe that. In addition to my free educational videos, I also run a free morning live stream. So during the live stream, we talk about what could be moving the markets that day. You get the opportunity to ask any questions that you want, and you can see everything that I see. So you can practice by just watching the live stream and tracking sim trades on your own. Now, the next thing is that how much money you will need does depend very heavily on the asset type you are trading. Startup and monthly costs will factor significantly into how much you need to start, especially in futures. And then if you're doing stocks, there's a whole pattern day trader rule. And I couldn't possibly cover all of that in one video. So what I'm going to do is I will make another video next month about what asset you should trade. And in that video, I'll get into the costs associated with different assets and why you should pick one over the other, etc. But what I really want to focus on in this video is the drawdown. In trading, you're going to have losing streaks. And if your account is not large enough to handle the drawdown caused by losing streaks, you could blow the account even if you have a strategy that is successful in the long term. So the question we're really trying to answer is, how big should your account be to handle the drawdowns that will naturally occur? So let's start simple with the most common rule day traders are taught, and you've probably already heard before, the infamous 1 to 2% rule. Simply put, you should never risk more than 1 to 2% of your account on a single trade. Now, I think the logic behind this rule is that it takes about 50 data samples for a normal distribution to reveal itself in statistics. So if you're only risking 1 to 2% of your initial account size, you can handle 50 to 100 losses. That should give you enough trades for the statistical advantages of their strategy to reveal itself. And it is a good starting point, but there's also some problems with it. For starters, markets are fat-tailed, and the more fat-tailed the distribution is, the more samples you need to reveal the full distribution. 50 trades is probably not enough. It also doesn't factor in the volatility of the market. If the market is too volatile relative to your stop, then you're just going to get stopped out all of the time. Let's talk about how we deal with these problems. Well, for starters, nothing beats a good programmatic backtest. I always say shoot for 5 to 10 years worth of data and/or 10,000 trades. If you're able to program the strategy up and look at the multi-year history of the strategy, then you can see the historical maximum drawdown of the strategy. We would then want to be able to handle a drawdown of at least that much. Of course, some things are beyond our ability to backtest. I use news and order flow and other things that are hard to get historical data on that could be used to backtest the mechanical strategy. So what do we do in that case? Well, we can study the instrument itself. We need to be able to handle the volatility of that instrument. So say we have a $1,000 account and we want to trade ES futures like pretty much every other futures trader. Well, 1% of $1,000 is only $10. Well, that's not going to work in ES futures because one tick is $12.50. Okay, so we can go to micro futures. That allows us to handle an 8 tick loss. Well, that's probably still not enough because the natural noise of the market is just more than that. There actually used to be a certain popular course out there that was essentially about having an 8 tick stop and a 4 tick profit in ES. And you know what happened was the S&P 500 grew and the volatility in terms of ticks increased as a result. So for a while, there was all of these traders that were like, how come I'm getting stopped out on all of my positions all the time? You know, of course it was a price action strategy, so it didn't actually work anyways. Let me show you some of the tools I have that can let you study the volatility of the market that you choose to trade. My favorite is the range histogram that I created for NinjaTrader. There's a version in my free indicator suite, and there's a more advanced version with additional options and filtering in the paid indicator suite. Both versions are available to download on my website at speculatorseth.com. So I'll show you an instance here. We can see the range of 5-minute bars. So I've done some filtering, and this is only showing the most active morning hours. I'm also using advanced options. And basically what this does is the value of all of the blue bars added together are equal in value to all of the white bars. The most common range in that period is 10 ticks, with a significant drop off at 20 ticks and another drop off at 30 ticks. So the chances of getting stopped out of a position is actually still pretty high, even with a 30 tick stop. Now, another way that we can look at this is looking at the daily volatility. Studying the volatility of a 1 or 5 minute chart yields pretty inconsistent results, but daily volatility is a lot more reliable. Of course, the VIX is the ultimate measure of volatility, but we're just looking at past market volatility here. So for this, I like to use ATR, or average true range. Here I'm using a version of ATR that is included in my paid NinjaTrader indicator suite that just allows me to show ATR in terms of different units instead of just points. I can show it in the dollar value of the range. So right now, the daily ATR of ES is about $4,000 per contract. That means if you were to buy at the low of the day and sell at the high of the day, on average, you would make $4,000 per contract. Day trading with selective outright positions is only going to capture a small portion of that volatility. So you could represent the leverage of your account as a ratio between the dollar value of your account and the dollar value of the ATR. The benefit of such a ratio is helping you convert between instruments. If we know what risk we can take in ES, then we can translate that over to other instruments based on their ATR. There's still kind of a problem, right? That doesn't tell you how big of an account you actually need to handle the drawdown. So let's try another approach. So how about we try a Monte Carlo simulation? Seems like we did that in some other videos recently. Now, NinjaTrader does have its own kind of Monte Carlo simulation feature, but we're going to program up our own strategy. So what I've done is I've made a strategy that is completely random to test against. Each day at the start of the session, it selects a random time and direction to take a trade. To take that random trade, we're going to use a random number generator that will take a seed as its input so that we can just pass the same seed into it in the future and duplicate a specific run. The strategy then holds the trade for 30 bars before exiting. So we're essentially exposing ourselves to the market for a set 30-minute time period. Now, maybe you want to only expose yourself to 5 minutes per trade, or you want to take multiple trades per day to better match how you yourself trade. So what I'm going to do is I will put the code up on the $3 Discord for you guys so that you can trade and adjust it yourself. Oh, that's right. I have not talked to you guys about the $3 Discord outside of the live stream, have I? Okay, so there is a lot of problems with having a public Discord and getting private message spam that only Discord themselves can deal with, and we can't really do anything about. So the free Discord will continue to be there and is still the best and largest free futures trading Discord out there with tons of information and resources that you can search for. But we've also created a sister Speculator Seth subscriber only Discord for $3 a month. $3 because that's the lowest that Discord will let us make it. It's a trivial amount that everyone can afford, but it keeps out the bots and other problems. I plan on putting more and more content over there, so check it out in the video description below. Anyways, back to the test. What we're gonna do is run the strategy over the past 5 years, 1,000 different times, and look at the maximum drawdown of all of the different runs. Now, I want to do some visualizations that NinjaTrader doesn't do. So what we can do is export this table and then draw a density/distribution graph using R. So on this chart, the x-axis is the drawdown of the account and the y-axis is how common that drawdown was. The peak in the graph is around $16,000. You should probably expect at least that much. And the tail of this distribution starts around 40,000, which interestingly enough is 10 times the daily range. So anyways, we'll divide that by 10 for micros, and that means that maybe $4,000 is a good place to start if you're trading micro ES futures, which seems to fit, but is a little bit more than what I think most retail traders are starting with, especially if you're going to trade multiple contracts, right? Here's the thing though. Remember that backtest is 5 years. So you don't necessarily need to have all of that money right at the very beginning. I didn't. I started with the minimum account balance and then set aside money every month instead of wasting it all on funded trader combines. Of course, make sure that you're already contributing what you need to your retirement accounts like your IRA and your 401k. We need to be at least a little bit responsible, right? It's kind of funny because I spend a lot of time on this channel talking about the risks of trading, because really the reality is that day trading just isn't appropriate for most people. A lot of people are only in it for the money, and you're probably better off starting a small business or getting into startups if money is really what you're after. But today, I want to say the opposite. For those of you like myself that are just absolutely hooked and you want to be involved in the markets one way or another, don't let the cost of entry discourage you. It is absolutely within your reach. That's one of the biggest mistakes that I made over the years. I didn't trade the way that I wanted to trade because I didn't have enough capital yet. So I started trading other things that really didn't work as well. That's a trap that usually herds you into games that you can't win. So don't be in such a rush to start losing money. You've got the whole rest of your life to become a trader. Spend some time, save up, and do it the way that you want to do. So I would love to know what you guys think of the data that I presented in this video. Is it too aggressive, too conservative? Let's discuss it in the comments. Meanwhile, stay excellent, team.